Ratios and common-size income statements are essential tools in financial statement analysis because they help analysts evaluate profitability, efficiency, and operating performance across companies and time periods. The program explains that common-size income statements express each income statement item as a percentage of revenue, allowing analysts to standardize financial data and remove the effects of company size. This standardized format improves comparability among firms operating in different industries or markets. Ratio analysis complements common-size analysis by converting accounting figures into meaningful performance indicators. Together, these tools help investors, creditors, and analysts identify trends, assess risk, and make informed decisions regarding investment, lending, and valuation activities. A vertical common-size income statement expresses all line items relative to total revenue. This format highlights the proportion of sales consumed by expenses such as cost of goods sold, selling expenses, interest costs, and taxes. According to the program, vertical common-size analysis is especially useful for studying trends in costs and profit margins over time. Analysts can quickly determine whether profitability improvements result from higher revenues, better cost control, or reduced financing expenses. For example, declining operating expenses as a percentage of revenue may indicate stronger operational efficiency. Common-size statements therefore simplify financial interpretation and direct analyst attention toward key drivers of business performance and earnings sustainability. Profitability ratios derived from the income statement provide deeper insight into a company's operational success and competitive position. Two important measures highlighted in the program are gross profit margin and net profit margin. Gross profit margin measures the percentage of revenue remaining after deducting the cost of goods sold, while net profit margin measures the percentage of sales retained after all expenses. Higher margins generally indicate stronger pricing power, cost management, or product differentiation. Analysts compare profitability ratios across firms and over time to assess operational efficiency and strategic effectiveness. Significant changes in margins may also signal evolving industry conditions, changes in input costs, or shifts in management performance and business strategy. Horizontal common-size analysis complements vertical analysis by examining changes in financial statement items over multiple periods. In horizontal analysis, figures are typically expressed relative to a base year, allowing analysts to observe growth trends and changes in business structure. The program notes that horizontal common-size statements make trends in revenues, expenses, assets, and liabilities readily apparent. Analysts use these trends to identify unusual fluctuations, assess growth sustainability, and evaluate whether cost increases are proportional to sales growth. Horizontal analysis is especially valuable when forecasting future performance because it reveals long-term operational patterns, cyclical influences, and strategic developments affecting profitability and financial stability. Ratio analysis extends beyond profitability measures to include liquidity, activity, solvency, and leverage ratios. The program emphasizes that different ratios evaluate different aspects of financial performance and risk. Activity ratios such as receivables turnover and inventory turnover measure operational efficiency, while liquidity ratios such as the current ratio assess short-term financial strength. Solvency and leverage ratios evaluate long-term debt capacity and financial risk. Analysts often integrate these measures with common-size statements to gain a comprehensive understanding of a company's operations and financial condition. Interpreting ratios effectively requires comparison against industry averages, historical trends, and competitor performance rather than relying solely on isolated numerical values. Although ratios and common-size statements are powerful analytical tools, they also have limitations that analysts must recognize. Accounting policy differences, non-recurring items, seasonal effects, and management estimates can distort financial ratios and reduce comparability across firms. Additionally, ratios alone cannot fully explain the economic reasons behind changes in performance. The program notes that common-size analysis points analysts in the right direction, but does not tell the entire story about a company's operations or cash flow prospects. Effective analysis therefore requires combining quantitative techniques with qualitative evaluation of industry conditions, competitive strategy, management quality, and broader economic factors to produce accurate conclusions and reliable investment decisions.